Smart money added massive gold exposure again this week. My primary bias remains strictly bullish, but the real opportunity appears after a liquidity sweep. Let me show you what institutions are positioning for. We are tracking these flows in this explainer.
We are explicitly targeting buy-side liquidity above 44.50. This week's opportunity is absolutely massive. However, it requires extreme patience. You cannot just buy anywhere blindly. You must wait for their trap to spring.
So what is smart money actually engineering for next week? Based on COT positioning, institutions are engineering a liquidity sweep. They need this before a major upside expansion. They never move price without securing liquidity first. This is how the real game is played. Most traders will focus entirely on price action. Smart money focuses exclusively on resting liquidity pools. Retail constantly chases breakouts and fears false breakdowns. Institutions let retail provide the necessary liquidity. This is a fundamental divergence in strategy. Let's look at Section 1, Smart Money Footprints. Notice this institutional positioning matrix. Managed money aggressively builds long exposure. Meanwhile, swap dealers provide the counterparty liquidity. They warehouse the risk for the street. This entirely validates our bullish institutional bias. Look at this massive accumulation. They added almost 9,000 contracts in 1 week. This shows high conviction, bullish intent. They are the primary market drivers right now. Institutional capital is clearly forcing the price higher. But here is what most retail traders are missing. This long accumulation requires a specific macroeconomic environment. You must understand the underlying macro capital flows. If the macro environment shifts, the trade fails. Moving to Section 2, Macro Liquidity Targets. We must align institutional footprints with macroeconomic shifts. Retail constantly fears short-term, 2-year yield spikes. However, the data reveals something completely different. Institutions are actively hedging against commodity inflation instead. The long end of the yield curve remains anchored. This brilliantly illustrates the current macro tape. Energy commodities like heating oil are surging higher. Meanwhile, volatility is collapsing rapidly. This confirms a risk-on inflationary growth environment. Gold naturally thrives in this exact inflation dynamic. Simultaneously, speculative capital is fleeing the US dollar. Smart capital is flowing out of the greenback. This removes major structural headwinds for gold prices. A weaker dollar naturally fuels this institutional rally. Let's check Section 3, the price action map. Now we apply smart money concepts to the chart. This creates a highly probable structural roadmap. Phase 1 shows a daily break of structure. Phase 2 is our current retracement. Phase 3 requires an internal liquidity sweep. Finally, Phase 4 targets the buy-side liquidity above. The execution steps are incredibly clear here. Step 1, they sweep sell-side liquidity below 43.10. Step 2, they tap the 4-hour bullish order block. Step 3, they expand rapidly to 44.50. This is algorithmic institutional precision clearly at work. Section 4 covers the retail trap. This is where most retail traders get trapped. A dip into the 43.20 region changes everything. It will trigger extreme retail panic selling immediately. Their stop losses will be hunted incredibly aggressively. Institutions rely entirely on this exact retail panic. They buy when retail traders are forced to sell. The true institutional objective is deep discount accumulation. They need this before Thursday's FOMC minutes release. That engineered panic provides the exact necessary counterparty liquidity. They position themselves right before the major macroeconomic news. Here is Section 5, our weekly trade plan. We are buying the dip strictly into the demand zone. Our ideal entry is between 43.15 and 43.40. Our stop loss rests safely below 42.75. Our primary target is the liquidity pool at 44.50. This setup offers an incredible risk-to-reward ratio. A daily candle close below 42.50 completely invalidates this bullish structural bias immediately. We also have a major macro volatility event approaching. Thursday's FOMC minutes could trigger a sudden yield spike. Reduce your position sizing by 50% before this, or simply stand aside 30 minutes prior to the release. Always protect your institutional trading capital first.
If you enjoy institutional gold analysis using smart money concepts, subscribe to ICT Market Theory. We track the real institutional capital flows constantly. Join our elite community of highly focused institutional traders. Leave your personal weekly gold bias in the comments below. Let me know exactly what you see in the charts. Also, find the trading account link pinned below. You can closely follow future trading opportunities right there. We rely on data instead of mere retail emotions. The institutional liquidity matrix is firmly set right now. The macro targets are completely clear on the chart. The engineered retail trap is perfectly laid out today. Will you fall blindly for the engineered retail trap, or will you trade alongside smart money capital flows?